Hello students, I hope you're all doing well. Welcome to another video from QuickStudy. This video covers business revenues, costs and profit from topic 1.3, putting a business idea into practice. So without any further ado, let's get started. In this video, we'll learn about the concept and calculation of revenues, total costs, fixed costs and variable costs, and we'll also talk about profit and loss. So firstly, we are going to discuss what revenue is. Well, revenue is essentially the sales that you make from selling your products or service. And how is this calculated? This is calculated by multiplying the number of products that you've sold with the price of each product. And to give you an example, if a football club sells 7,000 tickets, where each ticket is priced at £20, their total revenue is going to be 7,000 multiplied by £20, which will give you £140,000. Now, here's the thing. The prices of the ticket are determined by the club itself. However, what is uncertain is the number of tickets that are going to be sold. Now, if a football club assumes to sell 50,000 tickets, but in reality they were only able to sell 30,000 tickets, it creates a difference, right? And even for a well-run football club, that difference could be significant, and this could lead to certain significant changes in your business planning. Since we have already discussed revenue, let's talk about prices. First of all, you need to understand that for some businesses, prices are out of their control. And this is especially true in situations when the market changes quickly due to demand and supply factors. If I were to give you an example, in Africa, farmers saw the prices of cotton drop by over 50% in a year, which was due to demand and supply factors, and this had significantly impacted their livelihoods and income. And similarly, in an industry where competition is direct and fierce, the pricing strategies are not always in your favor and not in your control. And an example for this could be Ryanair and easyJet. If you see that Ryanair has decreased their prices on their ticket prices and easyJet has to follow through, even if they have to give up significant profitability. And similarly, prices are hard to predict when you're operating in an industry with a new product and you're not really sure about customer response. And a good example for this could be when the Xbox One was launched in the UK in 2013 and it was priced at £429, but only in a span of 1 year they had reduced the price of Xbox One to £329 since they were not selling enough units. And you see, it's crucial that you understand these factors properly so that you can operate actively in markets with volatile conditions. And now you need to understand about quantity demand a bit. You see, occasionally you'll be able to confidently say about how much demand there is for a particular product. If I were to give you an example, Beyonce tour's concert tickets would always sell out, and it's safe to say that the next one will sell out as well. And similarly, Heinz's baked beans are quite profitable and quite popular as well. So if I were to make an assumption of their sales forecast for the next 6 months, it would be quite accurate. And this is exactly what allows Heinz to ensure that they have enough raw materials, ingredients, and staff in place. And managing this type of business is comparatively easy. However, that's not really the same case for planning the revenues for an upmarket restaurant in London. And that's for various reasons as well. First of all, their customer groups will include various kinds of people, starting from business people to visitors to wealthy Londoners. And in 1 week, the restaurant would be full, whereas in the other week, the restaurant might be empty. And it could be empty because of reasons like an economic downturn when people do not have enough jobs and they're cutting down on luxury spending. And another reason could potentially be a newspaper review who are saying that their food is too mundane or dull and is just overpriced. So another important factor that you would need to consider, and it's associated with your product or service, is the costs that you incur. So if I were to give you an example, what would you do if you had to start up a kiosk and sell coffee? First of all, you need to look at the different type of costs that you incur, right? So first of all, you'd incur some costs for the real shot of coffee, then you'd incur some costs for the milk and sugar, then you'd have to bear additional costs for the paper cups. Now, when you add all those costs up, what you get is essentially the total direct costs. Now, what do? You essentially add a markup to all the costs that you've incurred and sell the product at a higher price, or the coffee in this example, and you make a profit, right? Not really, it's not so simple. So there are other costs that you need to take into consideration as well. So first of all, you've acquired the kiosk for which you've had to pay extra money. Then there is machinery and you might have to pay salaries to the staff, and you might also have to pay an accountant to manage the taxes for you. And for someone who starts a business, identifying and quantifying all these costs easily can be one of the hardest tasks. So first of all, you need to realize that there are two different kinds of costs. There are fixed costs and there are variable costs. So first of all, let's start off with variable costs. So what are variable costs? These are costs that will vary and change with the level of output produced and sold. If I were to give you an example, say for example, Walker's made a brilliant new advertising campaign, and this has led to twice as much as sales. And this would lead them to buy twice as many potatoes, and they would have to spend twice as much on their packaging as well. And these are variable costs, which will rise and fall according to their level of output. And what are fixed costs? Fixed costs are costs that do not change with the level of output produced or sold. If I were to give you an example, the rent on a clothes shop must be paid whether you have had terrific sales or no sales at all. You see, and similarly, the landlord of your house can increase the rent over time. So fixed costs do not really stay fixed indefinitely. They will change over time. And fixed costs are often related to a time period as opposed to your sales or output. And an example of this would be the rent paid or the salaries you pay to your staff, which is on a monthly basis, and it does not really depend on the amount of sales you've made in a month or a particular period. So since we have talked about revenues and costs a bit, now let's look at profit. So what is profit really? It is basically the difference between your revenues and costs. So the formula to calculate profit would be revenues minus costs equals profit. And you also need to remember that if your costs are greater than your revenues, you'll of course make a loss. And if I were to give you an example, Morrisons Supermarket made a huge loss in 2015 of £800 million, and it was due to operating inefficiencies. However, soon enough, only in a span of 1 year in 2016, Morrisons Supermarket was able to convert that huge loss into a profit of £200 million. And that was because they had improved their organizational efficiency. And for new small firms, achieving profit in the early days can be really difficult, and that could be for many reasons. One of them being that the costs may be higher due to operating inefficiencies, of course. And another reason could be that your revenues are slow because not enough positive words have spread around about the quality of your service. And profit is essential for long-term business success. You see, surplus of revenue over costs can provide you with capital that you could use to replace your old machinery or vehicles. And you could also use the extra money for further business growth and expansion. And you need to realize that profits are really important because many businesses will occasionally have awful years, and a reserve of cash in place can help you balance those losses out, right? And this is essential for long-term success and sustainability. If I were to give you an example, in 2016, easyJet announced a loss of around £40 million after the Britain decided to leave the EU. And saving profits for the future for a rainy day makes good business sense. And it basically helps you to buffer against unexpected losses or downturns. And similarly, a profit ensures financial stability and flexibility for your business. And students, with that, we have come towards the end of this video. To give you a short recap of what we have covered in this video, we have talked about the concept and calculation of revenues, costs, which includes fixed costs and variable costs. We have also discussed profits and losses. And finally, students, I'd like to thank you for watching this video. And if you've liked this video, do subscribe to our channel as we post regularly on different topics and subjects that can help you ace your GCSEs. And for more information on our online one-on-one tutoring services, do visit our website at www.quickstudy.uk. Thank you.